Imagine you've been shopping at the same grocery store your entire life. You know every aisle, the prices, and even the quality of each item. Everything is predictable, and you're comfortable with the routine. Then, one day, the prices on everything suddenly rise by 25%. The things you used to buy for a certain price are now much more expensive, and your trusted store feels less reliable. So, what do? You might start looking for a new store, right? You're not going to keep paying higher prices at a place you've relied on for years if there are better alternatives out there. This scenario is exactly what Canada is facing today. For decades, the United States has been Canada's main trade partner, a reliable neighbor and trading partner. But now, new tariffs and trade restrictions are making that relationship increasingly costly and unpredictable. Meanwhile, on the other side of the world, ASEAN, the Association of Southeast Asian Nations, presents a new opportunity. The trade barriers are lower, the market is expanding rapidly, and ASEAN's total economy is projected to hit $4 trillion soon. Canada is beginning to see the value in shifting its trade focus toward this region, offering new markets, fewer obstacles, and access to industries poised for growth. For instance, Vietnam alone had over $8 billion in trade with Canada last year, and Canada has already pumped $47 million into ASEAN projects. So, as trade routes to the U.S. become more expensive and filled with detours, the trade lanes to ASEAN remain wide open. The question now is, how long before Canada shifts more of its trade focus onto that highway? This shift represents a major turning point for Canada's trade strategy. For years, Canada has relied heavily on the U.S. for trade. This has been a safe bet. But now, as tariffs rise and trade terms become less predictable, Canada is looking to diversify. It's like a business that has relied on a single customer for years, but when that customer starts changing the rules, raising prices, imposing new restrictions, it forces that business to seek new customers before it's forced to do so. This is exactly what Canada is doing, looking for new markets to maintain stability and reduce its growing dependency on the U.S. The move towards ASEAN could be just the break Canada needs to reduce the risks tied to its long-standing trade relationship with the U.S. But this shift isn't just about finding new trade routes, it's about reshaping Canada's future in the global economy. ASEAN is not just another region to trade with, it is one of the fastest-growing trade blocs in the world. Countries like Vietnam, Thailand, and Malaysia are major manufacturing hubs, producing everything from technology to steel to consumer goods at record levels. Indonesia, with its vast energy resources, is also a key player in ASEAN's rise. Canada, with its own strengths in natural resources, technology, and green energy, is positioning itself as an ideal partner for ASEAN's expanding economy. Canada has already committed $47 million to projects in the region, focusing on green energy, mining, and electric vehicles, key sectors where ASEAN nations are looking for reliable partners. The time is ripe for Canada to secure its position in this fast-growing market. This moment is a defining one for Canada. For decades, Canada has relied on the U.S. for trade, and now it's facing a situation where it has to pivot. The U.S. isn't the only game in town anymore, and this is a pivotal shift in the global trade structure. The old trade routes, once smooth and dependable, are becoming congested and expensive. In contrast, the lanes to ASEAN remain wide open, with fewer trade barriers, more opportunities, and industries ready for expansion. The real question is how fast Canada can make the switch. This isn't just about taking advantage of a new market. It's about aggressively reshaping Canada's trade relationships on a global scale. The U.S., of course, is watching closely, but for now, it hasn't reacted aggressively. The trade relationship between the U.S. and Canada is immense. More than $800 billion worth of goods flow between the two countries every year, and Canada exports roughly 75% of its goods to the U.S. This makes the U.S. Canada's primary trading partner, and a 10% shift of Canadian exports to ASEAN would represent billions of dollars. The U.S. might not be reacting now, but that doesn't mean it isn't concerned. The economic impact of Canada reducing its dependency on the U.S. could be significant. The big issue here is that the U.S. does not like unpredictability. It doesn't like the idea of losing control over trade routes. Canada's move toward ASEAN could be seen as introducing a new, unpredictable factor into the global trade scene. The U.S. has already begun tightening trade terms, raising tariffs, and imposing new rules to make it harder for Canadian exports to remain competitive. This creates a dilemma for Canada. Should it try to negotiate harder with the U.S. to preserve the old relationship? Or does it fully embrace ASEAN as a way to reduce dependence on the U.S. altogether? This decision will have profound consequences on North America's trade dynamic. If Canada decides to make a clean break and commit to ASEAN, it risks walking into a room where China already holds a significant amount of influence. China is already ASEAN's largest trading partner, with nearly $1 trillion in trade flowing between them each year. Many of ASEAN's biggest industries, manufacturing, energy, and infrastructure, are closely tied to China's economy. If Canada becomes more entrenched in ASEAN trade, it could end up strengthening China's grip on the region. But this isn't about picking sides between the U.S. and China. It's about building trade relationships. By increasing its exports to ASEAN, Canada will inevitably build connections with Chinese supply chains, adding a level of complexity to Canada's trade strategy. This leaves Canada in a delicate position, caught between two global superpowers, each with their own competing interests. On the ground, Canadian businesses are feeling the pressure of these shifting trade dynamics. Some businesses are already shifting their focus to ASEAN, finding new opportunities, but not every business can pivot quickly. Manufacturers that rely heavily on U.S. buyers are feeling the heat from rising tariffs, while other industries are grappling with completely different regulatory environments. The shift is happening in real time, and Canadian businesses are having to adapt or risk being left behind. For some industries, especially energy, mining, and agriculture, such rapid shifts are harder to manage. These sectors typically require long-term contracts and investment, and they can't pivot as quickly as tech companies can. This is where the real challenge lies. Can Canadian businesses make the transition to ASEAN quickly enough to secure their future? ASEAN countries already have established trade agreements with major global players, including China, Japan, South Korea, and the EU. Canada entering the market doesn't guarantee success. The competition is fierce, and Canada isn't the only country trying to secure a piece of the action. So, what does Canada bring to the table? It has abundant natural resources, including energy, metals, and minerals. Canada also has expertise in technology and green energy, two areas that ASEAN countries are increasingly interested in. But ASEAN doesn't need Canada as much as Canada needs ASEAN. The real test will be whether Canada can secure long-term deals before ASEAN's larger trading partners lock up the best deals. On the surface, this shift to ASEAN looks like a smart strategy for Canada. It diversifies trade, reduces reliance on the U.S., and opens the door to fast-growing economies. But trade on paper doesn't always translate to real-world success. The ASEAN region is highly competitive, with countries like China, Japan, and South Korea already well established in the market. If Canada doesn't offer more competitive deals or find a niche, it risks being shut out of prime opportunities. Furthermore, shifting trade routes isn't as simple as flipping a switch. New logistics, regulations, and complex trade negotiations take time to iron out. If Canada doesn't act fast enough, it could risk weakening its ties with the U.S. without securing its place in ASEAN. The real danger for Canada is not just about securing deals with ASEAN. It's about making sure that those deals work in practice. Canada risks losing leverage in both the U.S. and ASEAN if it can't establish itself as a reliable partner in the region. The global trade landscape is changing rapidly, and Canada needs to move quickly before the dynamics shift again. It's a delicate balance. Too much reliance on ASEAN without fully securing the trade relationships could leave Canada in a vulnerable position. Ultimately, this is not just a trade shift. It's part of a larger story about the global race for economic dominance. If Canada successfully pivots away from U.S. dependency, other countries may follow suit, further shifting the balance of global trade power. ASEAN could open its doors even wider, and if the U.S. reacts aggressively, it could spark an all-out economic battle. The real question now is whether Canada can make this transition successfully before the global trade landscape shifts again. Will Canada be able to lock in the partnerships it needs before its competition does? More importantly, can it maintain a balanced relationship with both ASEAN and the US?